Hello friends, welcome to AARDHA. In this video, we will learn index funds. These are simple low-cost wealth building funds for long-term investors. First of all, let's see why index funds matter. The active fund challenge is most actively managed funds try to beat the market. However, many fail to outperform after accounting for higher fees. So, the index fund is the solution. Index funds offer low-cost passive investing to match the market's return with fewer risks and lower fees. Matching the market beats most effective managers over time. First of all, let's see the structure of index funds. These replicates an index like Nifty 50 Sensex. Strategy is passive, no active stock selection is needed. Objective is to match the index performance. Cost is very low, like 0.1 to 0.3%. Management follows index automatically. Key benefit is simple low cost exposure. Now let's see various types of index funds. Broad market funds like Nifty 50, Sensex funds, these are moderately risky. Sectorial funds like Nifty IT, Nifty Bank are higher risk. International index funds like Nasdaq, S&P 500 are higher risk. Choose based on risk appetite. Now let's compare index fund and active fund. In index fund, the expense ratio is very low, like 0.1 to 0.3%, whereas in active fund it is 1 to 2%. Performance of index fund matches index like Nifty 50 Sensex, whereas in active fund it may beat the index or it may lag behind. Index fund is ideal for beginners, whereas active fund is ideal for those seeking higher alpha. Lower costs gives higher return, higher long-term returns. This is the purpose of index fund. Index fund can be sold through AMC or NAV based, but see now let's see difference between ETF and index fund. Index fund is bought or sold through AMC or based on NAV, net asset value. But ETF should be traded in stock exchange in real time. See, these exchange traded funds are traded like stocks in the markets. Demat account is not required for index fund, whereas for ETF it is required. Index fund costs is expense ratio only, whereas for ETF you need to pay brokerage to the demat account. Index funds are simpler, no demat needed. Indian equity index funds. See, short-term funds, coming to taxation, short-term, if you are selling less than 1 year, 15% tax on gains needed to pay. For long term, if the gain is greater than 1.25 lakh, then 12.5% tax. For international index funds, for less than 3 years, it is treated as short term and tax is as per income tax. For long term, 20% with indexation need to be paid. Now let's see when to use index funds. Low cost long term. See, when you want low cost funds and when you want to hold the fund for more time, like say 5 to 10 years, then you go for index funds. No tracking needed. Set and forget investing. You don't need to track these funds on regular basis. Just invest in good time and wait for 5 to 10 years. You need diversification or systemic investment planning. Multi-sector monthly investing. Here you are diversifying because index consists of various stocks related to various sectors, right? So you are investing across the sectors and across the stocks. So risk is diversified. And SIP is a better way to invest in index funds than lump sum. These are simple, transparent, effective for most investors. Now let's see when not to use index fund. Seeking outperformance. Index funds match won't beat market. Want alpha? Then go for active funds. Niche sector focus. Specialized teams need active funds for better targeting. Tactical rebalancing. No market adjustment. Need active control instead. Index funds are passive by design. See, basically, if you are looking for higher alpha, you are looking to beat the market, you want active fund management, then index funds are not for you. Now, let's see various practical cautions. During market crashes, you might see negative returns in your index funds. So, there is no downside protection. Check ratios, low tracking error matters. In index funds, so check the tracking error. If tracking error is low, it is better fund. Sectorial risk, higher concentration volatility. Sectorial risk might exist in these funds due to higher concentration in stocks related to same sector. Currency risk, international funds will have this currency risk. Now let's see legality and safety. Here also nominee is not the legal head. Also use SEBI registered platforms only. Report fraud via 1930. Now let's see the summary. Index funds is ideal for long-term wealth with minimal costs, zero manager risk involved, solid market exposure. Buying the market, simple, reliable, scalable. I advise you start SIP instead of going for lump sum to build wealth, low cost, high clarity. Thank you.